Bitcoin is breaking down, not slipping, not correcting, not consolidating, breaking down. And the market structure forming beneath this collapse is one of the clearest technical setups we have seen since the 2022 cycle bottom. If you are holding Bitcoin right now or thinking about buying it, you need to understand exactly what is happening on the chart and why the next several weeks could define where this asset trades for the next 2 years. Let us start with what the price action is actually telling us. Bitcoin has been tracing a distribution pattern since it hit its all-time high above 109,000. The rally off the cycle bottom was textbook accumulation, and for a long time, the momentum was intact. But something has shifted. The recent breakdown through the ascending trend line that has held price since the lows is not a minor technical event. Trend line breaks of this magnitude, particularly when the break is confirmed with volume and follow-through across multiple sessions, typically precede a new phase of price discovery to the downside. The market is speaking in a language that technical analysts have spent decades learning to read, and right now, that language is unambiguous. The immediate support level that matters is around 65,700. There is a pivot low here, a price level where buyers previously defended the market with enough conviction to reverse the selling pressure. When price returns to a level like this, two things can happen. Either the buyers who defended it before return with the same conviction, and you get a multi-thousand-dollar bounce that can last days or weeks. Or the level breaks, and it breaks badly, because everyone who bought there the first time is now underwater and selling into the next rally rather than buying the dip. Traders call this the conversion of support into resistance, and it is one of the most reliable dynamics in any market. If that 65,700 level fails, and there is meaningful technical reason to believe it will eventually, the next major target is 60,000. Round numbers carry psychological weight in financial markets that far exceeds what any rational model would assign them. The 60,000 level is not just a round number, though. It corresponds to a significant historical consolidation zone, a region where enormous volumes of Bitcoin changed hands during the euphoric phase of the bull market. Those buyers are holders now, many of them long-term holders who will not capitulate easily, which means this zone has structural buying interest behind it. It is not a floor, because no level is a floor, but it is a region of meaningful demand. The more alarming technical formation on the chart is the potential head and shoulders pattern that is visible on the weekly time frame. For those unfamiliar with this pattern, it is one of the most studied and historically reliable reversal formations in technical analysis. It consists of 3 peaks, with the middle peak, the head, being the highest, flanked by 2 lower peaks called shoulders. The neckline connects the lows between these peaks, and when price closes below the neckline, the pattern is considered confirmed. The measurement technique is then applied by taking the vertical distance from the top of the head to the neckline, and projecting that same distance downward from the breakpoint. On Bitcoin's current chart, this measurement produces a theoretical target in the range of $35,000. That number is uncomfortable to say out loud, particularly in an environment where the broader narrative around Bitcoin remains aggressively bullish. Institutional adoption, spot ETF flows, government reserve discussions, all of this has created a cultural assumption that Bitcoin only goes up from here. But markets do not care about narratives. They care about supply and demand, about who is holding and at what price, about the balance between conviction and capitulation. And right now, the supply side of that equation is showing worrying strength. What makes the current Bitcoin setup particularly unusual is its divergence from traditional risk assets. The Nasdaq is making new all-time highs. The S&P 500 is in the vicinity of historical highs. Technology stocks, semiconductor companies, artificial intelligence plays, they are all participating in a bull market that shows no signs of exhaustion on a price basis. And yet Bitcoin, which spent the better part of 3 years trading as a high beta risk asset that moved in close correlation with growth equities, has completely disconnected from that rally. This divergence is not noise. It is signal. There are 2 ways to interpret this divergence. The first interpretation is that Bitcoin is telling us something about the broader market that the equities market itself has not yet priced in. Historically, Bitcoin has sometimes functioned as a leading indicator for risk appetite. It tends to move before equities because it trades 24 hours a day, 7 days a week, with a participant base that skews toward high risk tolerance and active trading. When Bitcoin starts declining while equities hold up, it can be an early warning that liquidity conditions are tightening, that the marginal buyer in risk assets is getting cautious, and that the eventual correction in equities, when it comes, could be substantial. Whether this correlation holds in the current macro environment is an open question, but the divergence itself demands attention. The second interpretation is more straightforward. Bitcoin may simply be experiencing asset-specific headwinds. The selling pressure from early long-term holders who accumulated in the sub-20,000 range has been sustained throughout this cycle. Miners are selling to cover operational costs in an environment where the recent halving cut their block reward in half. Institutions that bought the ETF inflows early are sitting on profits and rebalancing. These forces can overwhelm the bullish structural narrative for months at a time, as anyone who followed Bitcoin through the 2018 bear market or the 2021 to 2022 decline already knows. Now let us turn to Ethereum, because the situation there is, if anything, more technically damaged than Bitcoin. Ethereum broke its long-term ascending trend line well before Bitcoin did. This was an early warning sign that many observers either missed or rationalized away. The current price action suggests Ethereum is heading toward the $1,760 region in the near term. That level represents a confluence of support from the 2021 cycle, a range where price consolidated for months before the parabolic move higher. Below that, $1,400 represents the deeper technical support, and it would be dishonest to claim that level is out of reach if the broader crypto market continues to deteriorate. The ETH/BTC ratio, which measures Ethereum's performance relative to Bitcoin, has been in a sustained downtrend. This matters because it suggests that within the crypto ecosystem itself, capital is not rotating toward Ethereum. Whatever buyers exist are preferring Bitcoin, or increasingly, are moving further down the risk curve into specific altcoins that offer idiosyncratic narratives not tied to the Ethereum ecosystem. Solana is one of those assets. The price structure on Solana is constructive relative to what we are seeing in Bitcoin and Ethereum, but constructive does not mean safe, and it does not mean the downside is capped. Technical support exists around the $100 level, but in a broad bear market scenario, the $45 range represents a more historically tested floor. The performance divergence between Solana and Ethereum has been one of the defining narratives of this cycle, and it continues to play out in the price action. Solana's throughput advantages, its lower transaction costs, and its developer ecosystem growth have all been genuine catalysts, but price eventually reverts to reflect the underlying fundamentals of market structure, not just the technology story. There are a handful of altcoins that are behaving differently from the broader market, and this behavioral divergence is worth examining carefully. In the language of technical analysis, when an asset fails to make new lows while its correlated assets are declining, we call that relative strength, and it is often the first sign that accumulation is occurring at current levels. Polkadot has formed what appears to be a double bottom, a pattern where price makes two lows at approximately the same level, suggesting that sellers have been absorbed and buyers are willing to defend that price zone. The pattern is not confirmed until price breaks above the intervening high, but the formation itself shifts the probability distribution toward a bounce. Cardano presents an interesting case study in market psychology. The prevailing sentiment around Cardano in the current environment is deeply negative. This is paradoxically a potentially useful signal. When retail sentiment reaches maximum pessimism, when the consensus is that an asset is irrelevant and will never recover, the asymmetry of potential outcomes begins to favor the upside. Not because the asset is necessarily undervalued by any fundamental measure, but because maximum pessimism implies maximum short positioning, minimal new selling pressure from disappointed holders who have already exited, and the potential for a violent short squeeze on any positive catalyst. This is not an investment thesis in any traditional sense. It is a market structure observation. XRP is sitting at a critical technical juncture. The ascending trend line that has defined its price structure for several months is under pressure. If price violates that trend line and closes below approximately 1.21 to 1.22, the technical case for further downside becomes difficult to dismiss. However, if price holds that level and then breaks above the descending resistance line visible on the weekly chart, the setup transitions from bearish to aggressively bullish. These binary setups, where the outcome of a single price level break determines the directional bias for weeks or months, are among the most actionable configurations in technical analysis. The broader altcoin market is in a state that can only be described as severe technical damage. Most altcoins are down 60 to 90% from their all-time highs in dollar terms. Many are down even more dramatically in Bitcoin terms, meaning they have not just lost value in the global reserve sense, they have lost purchasing power even relative to crypto's own internal unit of account. This kind of multidimensional drawdown creates conditions where the risk-reward math starts to tilt for patient capital with long-time horizons. But it also creates conditions where further losses of 50 or 70% are entirely possible, because assets that are already down 80% can still fall another 80%. The macro context matters here. The Federal Reserve's interest rate policy, the trajectory of dollar liquidity, the performance of risk assets globally, all of these variables feed into the environment in which Bitcoin and the broader crypto market are trying to trade. The current environment is one where risk-free returns are still meaningfully positive, which means that the opportunity cost of holding speculative assets is real. Capital has genuine alternatives. This was not true in 2020 or 2021, when near zero interest rates made the expected value calculation for speculative assets appear far more attractive. The political dimension of crypto markets has also become impossible to ignore. Legislative developments, regulatory frameworks, and the posture of government institutions toward digital assets all create event risk that can move prices in either direction with little warning. Historically, markets tend to price in expected regulatory outcomes months in advance, which means that by the time the legislation actually passes, or the regulatory guidance is actually issued, the price movement has already occurred. Buying the rumor and selling the news is a phenomenon as old as financial markets themselves. Position sizing in an environment like this one is arguably the most important tactical decision a market participant can make. The worst trade in any market cycle is not getting the direction wrong. It is getting the direction right, but being so oversized that the volatility of the path from entry to target forces a liquidation before the thesis plays out. A position small enough that you can hold it through a 50% adverse move against you is a fundamentally different instrument than a position so large that a 10% move causes serious financial harm. The former allows you to think clearly. The latter guarantees that emotion will dominate your decision-making at precisely the moments when clarity is most valuable. The discipline of staggered entry, buying a small initial position and adding to it only as price declines to predetermined levels, is not a hedge against being wrong. It is a hedge against the psychological deterioration that comes from watching a large position move against you. When your first entry is a small fraction of your intended full position, you have structural protection against premature capitulation. You are not fighting the tape with your entire capital base. You are gathering information at a series of defined price levels, and each level where you add tells you something about the market's willingness to absorb selling pressure. For Bitcoin specifically, the levels that warrant attention from a risk-reward standpoint begin around 60,000, where there is historical support and where the psychology of round numbers should attract buyers. Below that, the 50,000 level represents a more aggressive entry point with a worse near-term outlook, but a potentially better long-term average cost. If the head and shoulders pattern plays out fully and the 35,000 target is achieved, that region would represent an extraordinary risk-reward opportunity for patient capital, assuming the fundamental case for Bitcoin remains intact. And the fundamental case, centered on absolute scarcity, decentralization, and the growing acceptance of Bitcoin as a sovereign-grade store of value, has not changed. The price action has changed. The technical picture has changed. The underlying reason for the asset to exist has not. The most dangerous cognitive error that investors make in bear markets is confusing price decline with fundamental impairment. An asset can fall 70% in price without becoming fundamentally less valuable. And an asset can be fundamentally less valuable while still rallying significantly. Price is the market's current estimate of value, not a statement of what the value actually is. The market is often right in the long run. In the short run, it is a mechanism for transferring wealth from the impatient to the patient, from the highly leveraged to the well-capitalized, from those who need to be right immediately to those who can afford to wait. The chart is telling a clear story right now. That story is not bullish. The technicals point toward lower prices, potentially significantly lower prices over the coming weeks and months. The risk is real and it deserves to be taken seriously. But the history of this asset class also tells a story, and that story is one of repeated cycles of excess and correction, each bottom lower in market time than the previous peak, each recovery eventually eclipsing what came before. Where exactly this cycle ends, and when exactly the next recovery begins, are questions that nobody can answer with certainty. What we can do is understand the structure of the market, identify the levels that matter, manage our risk accordingly, and avoid letting the noise of sentiment, whether euphoria or despair, override the signal of price action and historical context. The breakdown that is unfolding right now is significant. Watch the 60,000 level carefully. Watch the reaction at 65,700. Watch whether the altcoins that are currently showing relative strength continue to hold as Bitcoin declines. These are the data points that will tell us whether this is a standard correction within a larger bull market or the beginning of a deeper retracement into the territory that the head and shoulders pattern suggests. Both outcomes are possible. The price action over the next several weeks will begin to tell us which world we are actually living in.